All right, thank you for coming to this session. We're going to be talking about empty GOCs the day after. Moving on, moving past, ignoring that bullshit, not spending any more time and focus on the failures of one company, and instead focusing on how we can improve the industry as a whole, how we can make things better, how we can make Bitcoin safer for consumers, how we can get past outmoded regulation systems and use cryptographic solutions to regulatory problems. So it's my great pleasure to have 4 distinguished panelists here today. To my immediate right, Dr. Ryan Molecke joined Monetas from the research science and computing industry. Next to him, Chris Odom, who is the author of Open Transactions. Next to him, Yamamushi, who is a senior software engineer at Monetas. And last but not least, Justus Ranvier, Bitcoin enthusiast and activist. Welcome, everyone. So how do we move past GOCs? And how do we do things better now that we have programmable money? Justus, why don't you start?
I've been following Bitcoin since 2010 and watching the string of failures of services, insider thefts, external thefts, and all along been thinking, how do we fix this problem? It's a question that, a lot of people have asked, and last summer I came across the Open Transactions project, and I didn't really understand Open Transactions until I started coming to the Bitcoin meetups in Austin and met fellow traveler in person, and he really explained what he's got going on, which is I would say the perfection of accounting systems. Where Bitcoin has kind of perfected currency, Open Transactions has perfected liability accounting and brought cryptographic security to any kind of system where a liability is involved. And he explained this concept known as voting pools, where he can combine Open Transactions accounting to keep precise, unimpeachable records of what any service provider may owe their customers, and combine that with Bitcoin's multi-sig programmable money features to create systems where custodians of Bitcoins do not have the ability to fail to fulfill their obligations to customers, which is a technology that's never existed before. And I've been following closely, helping out where I can to make this project happen as soon as possible, trying to get the connections with the Bitcoin wallet software improvements that will need to happen for voting pools. But I strongly believe in the Open Transactions team and the voting pool concept, and I really want to see a world where exchanges are no longer a central point of failure that could just disappear with customer funds overnight with no recourse. And I think they can explain some of the technical details about how this will work, but we're going to see a world where it will be a competitive disadvantage for any service provider to have the ability to steal their customers' funds. And so all service providers will have to switch to technology that takes that capability away from themselves. And when that happens, we'll all be a lot safer. And we will never be able to make third-party custody holding of Bitcoins as safe as your own personal cold storage wallet, but we can raise the bar quite a bit, and we don't have to put up with this constant stream of customers losing funds to either incompetent or malicious third parties.
Yamamushi, you want to comment?
Well, December of last year, Mt. Gox closed my account with $40 in it. Mt. Gox apparently had this policy I was unaware of where if you didn't log into your account, they could close it and take your money. So for all intents and purposes, Mt. Gox stole $40 from me, which I never received in return. And at that point, it became my goal in life to fix these problems. Yeah, the price was $10 a coin at that point in time, so they owe me 4 Bitcoins.
Never piss off a geek.
Shortly after that, of course, the price ran up, April, March. to $260, and then everything crashed because of Mt. Gox's inability to process the trades. And I spent a lot of time thinking about this, and I realized, why do we have a decentralized currency with centralized exchanges? And what can we do to solve that? So that's why I'm involved with open transactions now. I met Chris at the Austin Bitcoin meetup, which I founded in April of last year, in response to the Mt. Gox crash, and the rest is history.
So one quick thing to point out, we talk about Gox having stolen 750,000 Bitcoin or lost or whatever. That's not counting 80,000 Bitcoin that they confiscated from accounts that they considered high risk or malicious. The total is actually 830,000 Bitcoin. Somewhere there is your 4. Yeah. So it wasn't just the 750. Chris?
For those who aren't familiar with what multisig is, it's the ability to send a Bitcoin transfer to, instead of just one Bitcoin recipient, to send it to multiple Bitcoin recipients simultaneously, such that they then have to vote in the future to release those funds. And so this is the concept in Bitcoin that we plan to use in open transactions, is instead of taking your Bitcoins and giving them to an OT server, who you have to trust him to hold those coins, instead you have a voting pool made up of, say, 10 servers or 20 servers, and the coins can go into the pool, and the server can issue units for you inside OT based on those coins the same way he would have normally. But he can't just disappear with those coins. He can't take them back out of the pool, because he would have to get the other servers to vote to release them on the blockchain, multi-sig. And it's very important because, one thing that stuck out to me that Justus was just talking about was, he said, a lot of customers are losing their coins to incompetent or malicious actors. And it's actually worse than that, because we're in a position where we can't really prove which one that it was. I mean, take many of these heists that happened in the Bitcoin community. Was it incompetence or was it maliciousness? My Bitcoin disappeared with everyone's money, right? And I believe that they claimed that they got hacked and that half of the money was stolen, and then they were going to come back and give the other half back or something like that. So let's say that half of the money was stolen. They freak out, they say, oh, half the money was stolen. Let's say that they secretly took it. Would you see anything different on the Bitcoin blockchain? You see some coins get transferred to some other address. That's it. Maybe they were incompetent. Maybe they were malicious. There's really not even a way of proving which one that it was. And so that brings us into a situation very clearly where you just have to prevent this from happening entirely. It just shouldn't be physically possible for them to do that. Now, if you have to trust, say, 10 servers, maybe it takes a vote out of 8 out of 10 of those servers to release the coins back out of the pool. Well, in that case, you still have to trust the pool. We haven't eliminated the concept of trust entirely, but what we've done is we distribute it more effectively over multiple entities who are nominally in business competition with each other. Even Bitcoin, I've said this before, even Bitcoin doesn't completely eliminate risk. What it does is it just distributes that risk effectively in such a way that we have this practical elimination of risk. It seems as though it's eliminated risk, well, even though there are still attacks, right? And the same is going to happen with the storage of coins in voting pools. Voting pools don't completely eliminate the concept of risk, they just distribute that risk.
So my name's Ryan, and I came to Monetas to work on open transactions out of the research science industry. So I made the choice to, instead of going and working on RNA and doing medical research, I came to Monetas and to work on open transactions. Partly for the money, but also because I think that this could be the most important project that I ever work on. So what I see open transactions is as an entirely new layer of the internet that's basically a financial layer of the internet that's, uses military-grade encryption to give people back control of their money. So, with the idea of people being able to issue stock or, run like a silver or gold ETF through open transactions, I really see this as sort of a new replacement, a more secure stock market. We're basically building a worldwide stock market that's more secure than the existing one, and will take power and money away from the existing financial elite. So that's generally my motivation. And so I think basically to your answer, how do we fix Mt. Gox and how do we fix these shady sites running away, is trust no one. You know, that's really the bottom line, is you can't trust anyone, and we have to build systems that are trustless as much as possible. So that's sort of my take on it. Yeah.
So we've heard a lot about custodian accounts or custodial accounts versus maintaining control over your own keys. And that's something I strongly believe in. You know, when you go to, the part of the problem with Gox was that they took control of your keys and they took control of your money, essentially taking it out of the security of the blockchain because you no longer had control over those keys. And they took it into this gray area that wasn't quite a bank, because those get regulated, so there's some protections, and it wasn't quite the decentralized currency of the blockchain, because there you have the control. It was the worst of both worlds, right there in between. So one of the other technologies that I've talked about in the past is to talk about cryptographic proof around solvency. So separately, even from distributing trust, you can also do cryptographic audit to be able to show whether an exchange that has custodial access to the accounts is maintaining their reserves securely. And that means proving that everybody's balance is accounted for. So can you talk a bit about that? Maybe if you want to, if one of you wants to provide a technical description. Chris, go ahead.
Well, as I said earlier, if you have a group of servers, say 10 servers, that are voting to release funds out of a pool, then if they vote to release someone else's funds out of the pool without auditing that other entity, then they would end up being the victim of that decision. You know, so for example, let's say a certain server is would fail an audit. Then if I'm a different server and I vote to allow him to release funds out of the pool, he's basically taking it from me. So that gives me an incentive to audit that server. And so in fact, the servers in the pool, they're not merely providing custodial protection of all the coins, but they all have an incentive to audit each other. So they're all being audited by each other in real time. And there's two sides to the audit. On one side, you have the open transactions receipts, and on the other side, you have the Bitcoin blockchain itself. With the open transactions receipts, it's pretty simple. The server can't forge any of your OT receipts. And the reason is because it's the client side that creates the receipt. The client side forms the receipt, which is the transaction request, sends it to the server verifies it, countersigns it, sends it back to him. So the server can't forge any of these receipts because the server can't forge your signature on the receipt. And then from there, as far as OT is concerned, those receipts need to match up to what we see coins actually exist on the Bitcoin blockchain. I think Justus probably has a lot to say about how we're doing this on the Bitcoin blockchain itself.
Well, storing the Bitcoins is it's going to require some new technology that hasn't existed in Bitcoin wallets yet. The current draft that we have for the wallet that would be used in voting pools will use BIP32 hierarchical deterministic wallets, but using them in a slightly different way, even though those aren't really deployed yet in a lot of places. So what happens is the voting pool, they're going to use a BIP32 seed to create their multi-sig output scripts. And they will pre-generate, for example, a year's worth of keys, because they're going to swap seeds every week. So they will accept deposits directly to cold storage, which is a little bit different than most exchanges who accept deposits to the hot wallet. And then every week they will switch to a new seed to start accepting their deposits. So they'll have blocks of deposits. Each block holds a week's worth of coins, if they're using that a week rotation. And then the hot wallet will be the oldest keys. So the Bitcoins will flow through the exchange. They'll come into cold storage and they will sit there until the withdrawal queue has caught up to them, and then they'll be sent out again. And that provides a very good way of tracking that the coins, that the private keys do exist. It'll make it very easy to count up the outputs, and doesn't provide the temptation for exchanges to do any kind of funny business like re-loan out keys, bitcoins that have sat idle for a few years. Because we would expect that if the exchanges are running 95% cold storage, that no deposit would sit there for more than 20 weeks. So that's part of the auditing. The audit server in the OT voting pool system, the one that is in real time checking the OT receipts of every other server in the pool, is the one that decides whether or not to create a withdrawal transaction. And that's the details of how that would work is actually what Yamamushi is working on.
So these are all technologies that can be implemented in a number of different ways, and they depend on a couple of things. They depend on the decentralized trust for the blockchain that allows you to trust a single source of authority about what transactions have happened. And then they depend on cryptographic primitives that allow you to build on that trust to establish different types of proof. One of those technologies is rather interesting, is called Merkle trees. Merkle trees are essentially trees, digital data structures, which are trees made of hashes, made of fingerprints. And one of the ideas suggested by Greg Maxwell, who's one of the core developers and a cryptographic genius in my book, is to use Merkle trees to do cryptographic proof of balance solvency. Basically, here's the idea. With a Merkle tree, you can take every single account you have in a custodial exchange system, and you can create a record for each user and their balance, and then you can create a hash of that. You sum up all of that information in a master hash and you publish that. And then each user has the ability to check that their balance was included. Now, you can combine that with another technology, which is homomorphic encryption, where you can take the individual balance amounts and add them up encrypted and create an encrypted sum. And then you can prove that all of the balances were counted and added up to the same encrypted sum that you can match against the blockchain. And these two technologies together allow you to do two interesting things. They allow you to prove you've counted everybody's money without revealing how much money anyone has. That's the trick. You're not just counting everyone's money, but you're not revealing any of the user balances. So you maintain privacy, but you still have proof. And then you're able to prove that all of those balances add up to the amount of reserves they should add up to without revealing any of the balances or the reserves. So these are the types of technologies that we can apply within a programmable money environment in order to provide certainty, in order to provide regulation by algorithm, and in order to provide auditable proof without regulators. Do you want to talk a bit about some of those technologies and how they might be implemented? Anyone?
I guess I might as well say that I actually implemented G. Maxwell's concept the other night. I think Sunday night I stayed up late and drank some coffee and coded it. So I'll probably release it open source in case anyone else wants to use it. Here's what it does. It creates a Merkle tree of configurable height and depth, and it allows you to, it's a template class, so you can have any kind of form of data in there, like user accounts being one good example, right? I have it for user accounts in the code that I wrote, but you could use it with anything. And it creates the Merkle hashes all the way up to the root. Now for the balances, I'm not homomorphically summing the balances, but I am hashing them, so there's a separate hash value that goes all the way up the tree to the root. But I think it'd be pretty easy to switch that to using homomorphic sum instead of a hash. I think I'm going to talk to Adam Back about it, because I've been talking to Adam Back already about using homomorphic numbers for the amounts in OT so that we can do our audits publicly and hide all the account balances simultaneously. So anyway, that's what I'm looking at. I'm going to email Adam Back, and if he can give me the actual function calls that will partially homomorphically encrypt the amounts, then I'll throw that in there. And we've actually done some research on some other homomorphic libraries, and it's still very much in academia land with that stuff. Like there was this one library that my lead software architect, Barry, did some research on it, And he comes back, and I said, well, tell me, can you encrypt an amount and then add it to another amount while it's encrypted? And he said, yeah, but the only amounts that it supports are zeros and ones. Like, you can encrypt a 0 and you can encrypt a 1. So I emailed the professor in charge of the code, and I asked him about this. I said, are we missing something here? Is there some extra ability that we can't figure out of the library, or is it just zeros and ones? And he said, oh, well, you have to implement your own machine. Like, you know, it's your problem. You have to take the zeros and ones and go create your architecture, how are you going to use them? So I realized this is very low-level stuff, you know. But Adam Back told me that he believes he has a solution, so I'm going to see about adding that in there.
Right, and even if you don't have homomorphic encryption, just with the hashes, the nice thing about this solution is that the customer themselves are the auditor. So the way it works is every time you log into an exchange, you see the root hash, and you also see the hash of your account, and then you can use either external software or a little JavaScript widget on the site to prove that your balance was counted in the total. Now, if your balance wasn't counted in the total, you start worrying that your balance isn't there anymore. So you have every reason to do this every single time. And you can get quite easily, say, a browser extension that's developed independently that does that for you. So each time you get into the exchange and log in or get into your brokerage or Bitcoin custodial bank, you can have a little pop-up that says your money's still counted as part of the total. And if you get customers to do that, the day they get a pop-up that says your money isn't counted as part of the total, you know there's something wrong. It's much better to have customers audit the business than regulators.
Yeah, I should just mention that the implementation I already have, just with the hashing of the value, it does do that, right? If I hash my balance, and then the next Merkle node up hashes the balance, the next Merkle node up, and so on, as long as the root hash matches, then it still proves my balance.
Yeah, you don't need homomorphic encryption for that. Now, there's a few further difficulties with this, because you've got to see how all of these things balance out. One is that you want to match it against the total balance in the blockchain, and most exchanges don't want to reveal the total amount of money they're holding. Right, so that's where homomorphic encryption would be more useful. You know, that may require human auditors to go in, but at least now what the human auditor is doing is they're taking one cryptographic proof system that sums up the balances and one cryptographic proof system that sums up the blockchain balances, and simply checking that those two numbers match. And then they don't reveal what those numbers are, but they can immediately check them, and they know that this audit happened correctly because it's cryptographically signed. Makes the auditor's job much better.
By the way, I happen to bring my laptop today so I can demonstrate this to anyone who's interested.
I might be interested in that.
One of the concerns I have with the proof of solvency is that it really doesn't address the theft issue. Because you can prove, once an exchange has stolen funds, you can prove that they did it. And you can prove that they haven't stolen funds, but you can't stop them from doing it.
Right, that's correct. I mean, we want to combine this with other techniques for control of the funds, like multi-sig or voting pools or both. Absolutely. But, you know, I think many exchanges can implement some of these features faster than others, and they all add up to much better security. One of the points I also wanted to make from our previous panel, and sorry if I've kind of jumped in as a panelist here, not a very good moderator, but is the idea that you also have to have human audit, which means that cryptographic proof is great. You also need to audit the process by which the system is operated. So the company itself has operational processes. They have controls. And you know, if you can protect the Bitcoin, but someone can go and sign out all of the dollars out of the bank with a single signature because they don't have essentially a banking multi-sig on their checking account, that's a problem. If an insider can hack into the database and change the code, that's a problem, and you can't fix that with cryptographic proof. You need auditable process. So there's kind of these two things go side by side and can need to work together.
Yeah. I don't fully agree with one of your points. I mean, most of that I agree with. There are, when you're using a voting pool, in the OT example, an insider who changes the code at one company can do no damage. And I look at voting pools kind of filtered through the lens of my background. I guess it's been almost a decade before. I was in instrumentation and control systems for naval nuclear reactors. And they have some pretty severe design criteria. They're very picky about how things work. And one of the most important criteria was known as the single failure criteria. And that said that no single component failure can cause or prevent a protective action. And that is like the Bible of instrumentation and control for nuclear reactors. And this is I see voting pools as bringing the single failure criterion compliance to exchanges. You no longer have to, even though you do want to make sure each and every member of the pool is following procedures correctly, it's no longer a disaster if one of them isn't. As long as a majority of them are, you can survive one or two, depending on the size of the pool. You can survive a minority of them messing up without encountering a disaster. That's one of the things that I see that process bringing.
It also enables censorship resistance, where we have exchanges all over the world, part of the same voting pool. An exchange is taken down by the government here in the United States. You won't be affected. You can still get your funds out of the voting pool by using any other exchange.
Yeah, I think that's a really important point also, is because with GOX or any other traditional exchange, there's only one place, whereas with open transactions, there could be banks or ATMs all over the world that are doing fiat to crypto exchange, and so there's not one point of failure in the fiat, who's handling the fiat. And also, I really think that open transactions will become a complementary system to Bitcoin and blockchain transactions, in the sense that if we can, as we can add more altcoins, anything that can support multi-sig basically can be put into a voting pool, and so you would be able to have a wallet with, all your different altcoins, all your addresses in one place with one security, key, a hardware key maybe. And then people will be able to run open transactions and be able to run exchanges. So we'll be taking the proprietary single exchange model and distributing it. So basically, if you look at Bitcoin as a program that you can run to make money off the transactions fees, mining eventually will be just for the transactions fees. But open transactions will enable you to make money off the conversion fees. So in that sense, I look at it as sort of complementary to that blockchain currencies.
For the voting pools, it's also important to note that, I'll let Justus explain this a little bit more, but anybody can audit the voting pool. They're not auditing themselves, that anybody with an audit server can audit the pool. He'll explain how that works.
Yeah, I believe they're currently implementing the auditing over bit message, because that's one of the security features is that you don't want the transaction server to know where the audit server is. Therefore, if a hacker breaks into the transaction server, the hacker doesn't know where to attack the auditing server. And the way this is being designed is that the pool could do all of the auditing internally, that only the specified audit servers know which bit message channel to listen to get audited data, or they could release that to the public and let anyone download the audit server code, hook it up to their pool contract, and the public could participate in the audit process.
So the reason this is all important is because at the moment we have a situation where regulators from all around the world are going to point to the recent exchange hacks, and they're going to say, you trusted the wrong people. You trusted Carpellis. So now we're going to come in and you're going to need to trust our people. To which we should be asking, you mean the same people like Bernie Madoff, who was the head of the National Association of Securities Dealers? He was the head of the regulatory board. Do you mean the same people like John Corzine, who's the governor of New Jersey and the head of Goldman Sachs? Do you mean the same people who failed to prevent the theft of $1 trillion in 2008? Do you mean the same people who put no one in jail? Do you mean the same people who went to Davos and chuckled next to Secretary Liu while talking about Bitcoin? Those people? No thanks. We don't want to take a situation where we trusted the wrong people and now trust some other wrong people. We want to trust math. And so what we need to do is persuade regulators that there's a better way of doing this. They don't understand this because this is a completely new paradigm. It's a new technology. Their job is to create trust. We need to give them the right answer to that question. And the right answer is not trust a different group of people. It's trust a cryptographic process that doesn't depend on people. So with that, I'll take questions from the audience for our panelists. Thank you.
Okay. Open transactions and cryptographic proof solvency was a concept that was thrown around yesterday. And I had Charlie Lee on my side, next to me, and I had the opportunity to ask him, well, for Charlie Lee's, he works at Coinbase, right? So my question is how technically feasible it is to implement, like open transactions for an exchange such as Coinbase. One of Charlie Lee's comments was that it would involve redoing the cold wallet system, the way they have it at Coinbase. So my question is what do we stand in terms of technology to implement open transactions in a major US exchange like Coinbase?
One of the things that open transactions does that probably Chris could talk about more is they have their own exchange functionality built in, but these exchanges already have custom order matching engines, would not need to use it. What it would happen is that the order book of the exchange would have its own open transactions identity. And when a customer wanted to make a trade, they would send funds from their open transactions identity to the order matching engine's account. That order matching engine would do its thing and then return the funds to whoever it belonged to. In this case, open transactions would be taking the place of their own custom funds, Bitcoin receiving and withdrawing functionality. It's what you would see as the technology starts to roll out is that all of these exchanges have their own custom ad hoc solution to dealing with the blockchain. And they'd be replacing that with the standardized solution provided by open transactions. And I think that's going to be a better plan just because most of these exchanges, their core business functionality is not dealing with the blockchain. It's doing all of this other functionality. And certainly in Mt. Gox, it looked like the case was that dealing with the wallet was an afterthought. So that's not where their primary focus was. He was worried about a trading engine. Now, with the open transactions right now, that's what they're working on. They are working on securing the blockchain. And so their software is going to be more focused on that problem because they don't have the distractions.
Yeah, to your point as well, cold storage is not easy to implement. It's not easy to implement in a way that's both secure and survivable. If you make it very secure, you restrict the number of keys and require very high thresholds in order to unlock the keys in the cold storage. That makes it less survivable. If you make it survivable by distributing the keys broadly and requiring lower thresholds, that makes it a lot easier to seize or compromise by blackmailing, finding, suing, seizing, asset forfeiture, warrants, etc. on the principles. It's actually difficult to implement cold storage within a single company. So one of the things we need to think about is not about how Coinbase does it, but think about the fact that there are currently 4 or 5 exchanges for Bitcoin in the world, really, with any serious liquidity. And over the next year, we're going to see 40, and then we're going to see 400 exchanges. And if we can get the next 396 exchanges to do it right, it doesn't matter. When you see a new exchange and it opens up, and on their website they say, we use military-grade browser security, which means SSL, you say, that's not fucking good enough. Do something better. Demand answers. Don't be satisfied with platitudes, and don't put your money in unless you're totally satisfied with the answers you get. And one of the questions you should be asking is, how are you implementing cold storage? How are you implementing voting pools? How are you implementing multi-sig technology to help protect our funds? If you don't get the right answer, don't go there. The thing is, the new users will not ask those questions, so we have to ask them much louder.
Yeah, also on that point, to say how easy will it be? I mean, ideally, someone that wants to get up and run open transactions, they won't have to compile it from source. You know, we will provide executables and we'll get it so that it will be as easy as possible for someone to just download it and make a server key for themselves and just run it. So
very, very quickly, I'm sure we're running low on time. My understanding every time that I hear people talk about distributed exchanges, in my very simplified way of looking at it, it always seems to come back to the one central problem, which is you're not trading bitcoins for bitcoins, right? You're trading something for something. So there's the digital part of it, but there's always the tangible part, right? So how do you deal with the security of whatever that tangible thing is, whether it's a yen, a single dollar, because at that point, that transfer point, there's a guy, right? There's a person, there is a Mark Karpeles, there is somebody somewhere that has to go through. Does anything that you're doing address the risk that's involved in that, or does it ultimately all just come down to minimizing and distributing the influence of a single point of failure?
It definitely comes down to minimizing and distributing risk for the simple reason that I believe the complete elimination of risk is impossible. I think it's a utopian pipe dream to completely eliminate risk. But as I said earlier, I think even Bitcoin hasn't completely eliminated risk. It's just shown us a good example of how to distribute risk effectively to where we have this practical elimination of risk. So my philosophy has always been to separate powers and distribute them. So it's not just that you have a single point that has powers, but that he has multiple powers. And I like to separate multiple powers out separately and then distribute those. And so, for example, if you look at Mt. Gox, not only are they trusted to hold all the dollars, but they're also trusted to hold all the bitcoins, and they're also trusted to hold all the receipts with the account balances on them, and to put whatever number they want on those receipts, right? And they're trusted to handle all the bank wires in and out. And so you have this massive combination of powers into a single entity, and that's what I would recommend to anyone else when you're looking out at other things in the Bitcoin world, is ask yourself, how many powers do they have combined here into a single entity? How many things do I have to trust this thing to do, or this guy to do? So first of all, let's say that I want to put a fiat currency into an OT server, such as the dollar or the euro, instead of Bitcoin, which you're getting to with the trading, right? And so first of all, you said you're going to have some guy who's going to be trusted to hold the dollars. Well, first of all, that guy should not have a direct relationship, in my opinion, with the OT server. Whoever that guy is, he should not actually be issuing dollars onto an OT server, because then it's very easy to put a gun to his head later and ask him to stop issuing his dollars on that OT server. For example, let's say that OT server is doing untraceable transactions or whatever, and some jurisdiction doesn't want him to do that anymore, so they tell him stop using that server. So the first piece there is, instead of issuing the currency directly onto any OT server, in my opinion, he should be issuing it as a colored coin. He should be issuing the currency as colored coins, so that way he doesn't have any relationship with any OT server. He doesn't have to issue those coins directly onto an OT server, and instead, those coins, those colored coins, could be used on any server. Maybe there's 1,000 servers out there, and the users then can upload those dollar coins or euro coins into an OT voting pool the same as they would with normal Bitcoins. And it would work on any OT server. And now at this point, the issuer, who's holding the dollars, he has no control over what servers that his currency is used on. It's passed entirely beyond his knowledge and control, and therefore he's not liable for those servers anymore. This is the same argument taken by the Federal Reserve themselves. The position of the Federal Reserve is we're not responsible for what people do with our dollars. We're not responsible for Saddam Hussein having $400,000 in a suitcase when they pulled him out of a spider hole, because we had no control over it. It passed outside of our influence and control, and so we're not liable for that anymore. So same thing, a currency issuer who issues, say, a dollar-based currency or a euro-based currency is no longer responsible for what happens with those colored coins once they float out of his control. And at that point, the OT server itself doesn't have to be able to send or receive bank wires, and it doesn't have to store dollars or euros in any other way differently than how it stores bitcoins, and it can facilitate market trades. Now, users can send bank wires in and out of the issuer, right? But not all users, because I realized as long as the issuer serves as an issuer of last resort, that someone who's AML KYC compliant can wire in and out with him, then most of the other users out there don't have to deal with that issuer at all, because they can just buy and sell those colored coins from each other. And so that sort of removes the issuer from most people out of the loop in a sense. But there's still that one nagging concept that he's still trusting some guy to hold those dollars, right? Now there's solutions for that for custodial things, like for example, there's already custodial gold, and that's handled very well in the world today. But we think there's a better solution for that, which is it possible to issue a dollar-based currency or a euro-based currency or a gold-based currency and eliminate that issuer entirely? Just not have a guy who's trusted to hold the dollars or hold the gold or hold the euros. And I think the best solution that we've come across for that is from Justus, which is Lex Cryptographia. And I recommend everyone read that article, just Google for it, Lex Cryptographia, which we believe provides the potential for having dollar-based currencies or gold-based currencies without having to trust some guy to hold that gold. I don't know if you have anything you want to say about that, but
I don't know that we have time to get into that topic, but it's basically about using bitcoins to ensure other tangible things, because we can't use software to manipulate tangible things, but we can use software to manipulate bitcoins. Therefore, if bitcoins are held in some sort of an escrow, then in theory you could ensure arbitrary contract terms.
Basically surety bonds. Using surety bonds in Bitcoin form, then you can back up that someone's going to produce some other form of value. And if he fails to do so, then the bond covers it.
I mean, if we manage to get to a world where we can cryptographically protect all the Bitcoin, we can cryptographically protect all the cold reserves and cold storage, we can cryptographically protect the receipts, and out of an exchange, the only thing you can steal is the fiat. I think then that's a pretty good place to be, because then the headline changes to Bitcoin exchange hacked, Bitcoin ineffective, all the dollars are gone. The bank didn't do its work holding secure the dollars, but the Bitcoiners did their job right and held the Bitcoin secure. That's a headline that starts telling people, you know what, there's a problem with currencies that are off blockchain, and the dollar is off blockchain. 40 years from now, people will be studying classic currencies in economics school, and they won't be able to understand why we would use currencies without blockchains that trusted white old men to issue them with reckless abandon. That's a good place to be. So with that, we'll wrap up the panel. Thank you so much for the panelists, and thank you for your questions.